President Trump actually ripped the Fed during today's sell-off, calling the central bank clueless. Let's bring in Steve Liesman with more on that. Steve.
Yeah, Melissa, as you guys were talking about, it's been a consistent theme for the president to criticize the Federal Reserve nearly every day, but especially when there are big market sell-offs. What he does not blame is his own trade policies that economists believe are weakening the U.S. and global economies and look to consistently be the spark for this market volatility. I'll read you this tweet with the regular caution that it often contains significant misstatements. We're winning big time against China companies and jobs are fleeing. Prices to U.S. have not gone up and in some cases have come down. China is not our problem, though Hong Kong is not helping. Our problem is with the Fed, raised too much and too fast, now too slow to cut. Spread is, and I suppose he means here, the spread between the U.S. yields and foreign yields is way too much as other countries say thank you to clueless Jay Powell and the Federal Reserve. Germany and many others are playing the game. Crazy inverted yield curve. We should easily be reaping big rewards and gains, but the Fed is holding us back. We will win. The Fed has typically not responded to any of the president's criticisms. Worth pointing out, the Fed last cut rates when the outlook was for slower growth, but for China and the U.S. to continue talking, there were no new tariffs on the table at the time. If there is a recession, as is often implied by an inverted yield curve, here's how the Fed could potentially respond. Cutting rates would be an obvious thing. They have 8 quarter-point rate cuts left. Perhaps surprising the market would get a little bit more effect to it. It could obviously restart quantitative easing. It just ended tightening at the last meeting. And, of course, there's the possibility, which some folks are talking about, of a reverse twist. You remember during the financial crisis, shortly after, the Federal Reserve acted to reduce yields on the long end. They could take operations to raise yields and reinvert the curve. I will say with caution that I've not had any support or not heard any support from Fed officials on an idea of actually targeting the yield curve. Well, we'll get a sense next week at Jackson Hole of just how seriously the Fed takes the issue and the extent to which it feels a more urgent response may be needed, guys. Melissa?
Steve, Joe Livornia today was mentioning a 75 basis point cut at the September meeting.
I can't keep ahead of Joe.
Your head.
I can't keep. I said maybe 50, and Joe one-ups me on the 20 on the 75.
Well, if you want to surprise the markets, right? You can't. You can't go 50 is
you can't do the surprise
expected.
They expect, right? That would be the 50. Look, I think there's reason for the Federal Reserve to be cautious. You guys on the desk are smart enough to understand that the differential on real yields is far less than the differential on the nominal yields with foreign banks. If you were to look at it, I think I looked at it this morning, it's about a 60 basis point differential because European inflation is so much lower than U.S. inflation. So there's not that much to go, not that much difference between the two. The Fed, of course, can surprise and can use rates. The question is, do you use your ammunition before you're sure that it's really a very serious downturn as the market's expecting here?
Why wouldn't the Fed want to target a specific part of the yield curve? It seems like it would be so surgical, and it could be effective in uninverting that curve.
So there's a long tradition of the Federal Reserve targeting the short end and using the one tool it has, the funds rate. It stepped, I guess you'd call it, out of bounds or out of its normal role during an extreme moment when there were real problems and the Federal Reserve was really desperate to try to kickstart the economy and used Operation Twist, for which there are really mixed reviews. I think the Fed really, it's probably almost ridiculous to say this, the Fed really wants to get back to its knitting of controlling the curve, using the short end and using bonds. It wants to sell mortgages. I think one of the things that's happening here is that the Fed's dreams of getting back to normal are sort of going up in smoke.
Yeah, seems that way. Steve, thank you so much.
Pleasure.
Steve Liesman, let's trade this. Tim, what do you think?
Well, Steve is pointing out that you have a dynamic where the Fed certainly has a toolbox it can go to, but the question is, if we look at central banks, has any of it actually worked? The good news is that Europe actually has a bigger deflationary spiral. So those people that are looking at kind of this relative value trade, which still very much favors owning U.S. 10 years over German. The one part about what we haven't spoken about, the risk kind of dynamics tonight, is that we haven't talked about the dollar, which to me is reasserting strength and is certainly a bigger concern, because the next leg to fall is that emerging market currencies come under attack. And that is something that we have seen at multiple times throughout crises that haven't necessarily, by the way, the last couple have not emanated in emerging markets, but they've ended up there.
Makes sense. You know, Pete talks about being disciplined in the gold market. I totally get it, and he's right. This has been going on now for probably longer than he even mentions. The gold market's had this stealth rally that everybody's talking about. With that said, everything that Steve just talked about, that Tim mentioned, goes right back to the gold market. And I'll say this, and I'm not an economist, I say it all the time, but there's this mythology that somehow lowering rates magically makes economies do better. And Tim just alluded to this. They ain't really working that well in Europe, and clearly didn't work all that well in Japan. And my pushback would be, just because everybody else is going down that rabbit hole, why should we? I don't understand why it's the right thing to do. And quickly, in 2011, July of 11, then Citizen Trump was talking about the Fed keeping rates low, creating these huge asset bubbles. He was right then. I'm not quite sure what's changed in the last 8 years.